Hey everybody. Once again, my name is Lori Page and I lead the advisory team here at Sound Wealth Management. When was the last time you checked your portfolio balance? If your balance was less than it was the previous time you checked, you probably felt a bit of pain. Everybody does. Where exactly does that pain come from? It's called risk, and all investments involve some degree of risk. In finance speak, risk refers to the degree of uncertainty and/or potential financial loss inherent in an investment decision. In general, as investment risks rise, investors seek higher returns to compensate themselves for taking such risks. If the market has taught us anything lately, it's a good lesson about volatility. When many people think about investing in the market, they think about making money, and that's a great thing to think about. For some people, on the other hand, it's a scary thought because they think about losing money. In either case, these people are thinking only about the roller coaster ride that market volatility can take us on. Every saving and investing product has different risks and returns. Differences include how readily investors can get their money when they need it, how fast their money can grow, and how safe their money will be. But knowing a little something about the different types of investment risk can help you cope with market volatility and maybe even enjoy the ride. First, let's look at business risk. With a stock, you're purchasing a piece of ownership in a company. And with a bond, you're loaning money to a company. Returns from both of these investments require that the company stays in business. If a company goes bankrupt and its assets are liquidated, common stockholders are the last in line to share in the proceeds. If there are assets, the company's bondholders will be paid first, then holders of preferred stocks, and if you're a common stockholder, you get whatever's left, even if it's nothing. One of the advantages of investing in a stock fund versus a single company's stock in your retirement plan is that business risk is mitigated to a certain degree. Because your money is diversified among several companies, the business risk then is spread out. The same can be said about investing in a bond fund versus a single bond issuer in a particular single corporation. So now that we understand business risk, let's look at volatility risk. And this is the type of risk that you're likely most familiar with and the one that you hear about all the time in the media every day. Even when companies aren't in danger of failing, their stock price may fluctuate up or down. Market fluctuations can be unnerving to some investors. A stock's price can be affected by factors inside the company, such as faulty products, or by events of the company that has no control over, such as political events or market events. The 2008 financial crisis and the onset of COVID-19 were prime examples of market events that significantly affected stock prices. So now let's take a look at something else we've heard an awful lot about lately: inflation risk. Inflation is a general upward movement of prices. Inflation reduces your purchasing power, which is a risk for investors receiving a fixed rate of interest. The principal concern for individuals investing in cash equivalents is that inflation is going to start to erode your returns because your return isn't going up with the prices that you're paying. Now let's look at interest rate risk. Interest rate changes can affect a bond's value. If bonds are held to maturity, the investor will receive the face value plus the interest that they earned. If a bond is sold before maturity, the bond may be worth more or less than the face value. Rising interest rates will make newly issued bonds more appealing to investors because the newer bonds will have a higher rate of interest than the older bonds. To sell an older bond with a lower interest rate, you might have to sell it at a discount. Now, liquidity risk. This refers to the risk that investors won't find a market for their securities potentially preventing them from buying or selling when they want to. This can be the case with the more complicated investment products. It may also be the case with products that charge a penalty for early withdrawal or liquidation, such as certificates of deposit. If you'd like to take a deeper dive into market risk or liquidity risk or any of the other types of risk that we discussed here, or discuss what types or degrees of risk are appropriate for you, reach out to me and my team here at Sound Wealth Management at 941 932 4822 or schedule your no obligation consultation online at www.soundwealth.net, where Sound Wealth Management is more than just our name. Have a great day, everybody.